I've got a background myself on the investment side, and I saw a real opportunity to leverage those skills as an investor, working with different stakeholders to help, the economy in that circular transition. That kind of schizophrenic behavior of large corporates, where they want to kind of be part of the new world, but they also want to kind of stay with the old world. They find it inherently difficult to really invest in this. So we said, why don't we set up a fund, raise capital, and indeed support that transition. So this target we set ourselves was a fund of 25 million. As a first-time fund, first-time manager, you're actually going to be less credible if you raise 25. We actually were able to bring it to 175 million because we actually had much more interest than what we anticipated. If you don't have the track record, that you have a narrative, very clearly, okay, what are you going to do? Why is this important and why are you important in actually achieving this? Either need to have a track record or you need to have a narrative. Ultimately, this is only going to succeed if we can compete with whatever is the cheap fossil alternative, whether we like it or not. Ideas are great, but ideas without money or execution are simply hallucinations. They don't lead to anything.
Today's sponsor is Composites. Sourcing the right materials and tech for your composites project shouldn't slow you down. They are your ultimate US-based procurement partner, handling everything from raw materials and custom manufacturing to specialized industry staffing. Stop searching and let the experts scale your production. Visit composite-source.com or click the link within the description. So today we are closing our tour de UK, although we are in Brussels. So we went back to the European continent and we are closing it with a great interview. I'm really looking forward. So we have Jeroen here, but I will let him introduce himself. So Jeroen, if you could quickly introduce yourself and what you are doing.
Thank you. So my name is Jeroen Kelder. I'm the co-founder and managing partner of Infinity Recycling. We're an investment fund or an investment manager. And I've got a background myself on the investment side. We'll talk about it a little bit further. And I saw a real opportunity to leverage those skills as an investor, working with different stakeholders to help the economy in that circular transition. So that's kind of a bit of my background. As you said, I'm London-based, but actually quite often traveling around Europe, because also this transition is a transition that requires stakeholders from different continents, and it's ultimately a global problem that we're trying to solve. So in those journeys, great to meet you again, Yannick. Looking forward to our interview.
Thank you, Jeroen. So you mentioned obviously the international side of the business, because it always goes beyond borders. But let's come back to your background. So obviously you have a financial background, but you might just navigate us through what did you study and what brought you to become eventually, after a few steps, an entrepreneur yourself, starting a company, in this case being an investment fund.
Yes, no, I think that's an interesting journey. So I studied economics, monetary economics, so quite abstract, a lot about policy, a lot about, at the time, this was all about the unification of the euro. So that was what most discussions were about. I then ended up in business because I really wanted to also understand business finance, accounting, P&L analysis, etc. And I then ended up working for 18 years at a American company, General Electric, where I initially focused a lot of M&A. So not only the kind of execution of M&A transactions, but also, and that was for GE quite important, the operational integration of those same acquisitions. So it wasn't necessarily about putting capital to work, but it was all about how do you actually make effective use of that capital? How do you actually get these companies to properly integrate? Because as you know, a lot of M&A ultimately never really yields the right result, or at least not the results that were modeled at the start. I then spent some 12 years on the investment side, providing effectively capital across the capital structure. So think about leverage finance. So that's effectively the funding of leveraged buyouts.
Yes.
But also we provided junior debt into certain projects in the energy transition. And also the last years, we actually made quite a lot of equity investments, again, in kind of, sustainability startups and scale-ups. So it's that experience of investing across the capital structure. It's that experience of investing, I guess, hands-on, i.e. providing capital, but also really helping those investees with addressing some of those operational challenges. And I think also what is quite important in what I do now, what I've realized when I was at GE, that being at the time the most valuable company, is big companies quite often find it difficult to move forward in a transition. So they participate, but they participate quite slowly. So to give you an example, at the time where in GE Capital we invested a lot in renewable energy, think about offshore wind, think about solar, think about biomass. At the same time, the GE industrial business was still of the opinion that centralized energy provision would actually remain relevant. So they made at the time which was the largest acquisition, Alstom in France, which is all about centralized energy provision. So that kind of schizophrenic behavior of large corporates where they want to kind of be part of the new world, but they also want to kind of stay with the old world is something that I thought was quite interesting. And it's something that in this circular transition, this material transition, I kind of witness on a day-to-day basis where you have the big corporates that are stakeholders that typically participate in the dialogue because it's also from a marketing point of view good to talk about sustainability, but they find it inherently difficult to really invest in this. And that's also because their shareholders, typically these are publicly listed companies, don't really appreciate them venturing into something that gives a different risk-return profile. And you see currently the last years, and BP I think was an example, they had an AGM this week, a lot of them are withdrawing from renewable energy.
Yes.
And they're kind of betting on the old fossil industry. So that is something, I guess, combined those experiences really helped me, I guess, decide two things. One is it was a great learning school, and it really set me up very well understanding, okay, this is ultimately, any transition is ultimately an holistic transition that requires engagement, buy-in from the different stakeholders. I've really experienced this investing in the renewable energy transition. And I also realized that the incumbent industry is not really going to do this. So the opportunity for an investor is really that arbitrage between you've got proven technologies, you've got a demand effectively, you've got a market that will be coming. And it's that kind of, I guess, barren land that provides a lot of opportunities for specialized investment funds. So when I became independent, I helped a number of startups with, and investing my own capital. I helped them with raising larger sums of money and also advised them in some cases exactly on these challenges. They sometimes had great ideas, they had subsidies, but they struggled to understand how do we actually make this economically viable? Where do we, coming back to the discussion we had earlier before the interview, where do I locate myself? What ecosystem can I find? And how do I relate myself with the value chain partners? In one of those advisory jobs, I met my co-founder of Infinity Recycling, Jan-Willem Muller, who has a background in the commodity trade, and we're very complementary. And what we both realized is exactly this, is that there were already at the time a lot of, I guess, proven technologies in the circular space, but they all struggled with funding. They all struggled with operationally figuring out, okay, what are we going to do next? And they all found it very difficult to work with the established industry. It was quite often a little bit of David versus Goliath, which meant that they didn't really get support. If they did get support, it was at unfavorable terms. So we said, why don't we set up a fund, raise capital, and indeed support that transition, support those scale-ups with capital, with the operational support and also with this, embedding in the kind of broader value chain. That was a great idea, and obviously we succeeded. But I think what is probably important to highlight, that you mentioned the word entrepreneur, it took us probably the best part of 4 or 5 years to actually get it completely off the ground. So in other words, it really, I think you can achieve a lot of things. That goes for entrepreneurs, that goes for entrepreneurial fund managers like myself. But I think it's extremely important that you, if you don't have the track record, that you have a narrative very clearly. Okay, what are you going to do? Why is this important, and why are you important in actually achieving this? And that you then also really, I guess, strategically build the ecosystem that you need. So where we done a good job was actually working on building a network first, engaging with different stakeholders, and then getting some of them to actually commit to us. That effectively created liquidity, so we could actually build out a team, we could start making our first investments. And then you actually have the pedigree and the credibility to actually raise more financial capital. So really engage the institutional investors that ultimately will make the difference, because this, like any transition, is relatively capital intensive. So that's kind of, I guess, the journey from being in a big corporate, all the doors open, you're GE, to literally starting from scratch, working, in your attic, in your kitchen for 4 or 5 years, earning absolutely nothing, but really having the belief that this is actually a market that's going to be there. This is a market that requires somebody looking at it from arm's length, but who's able to kind of tie all the different dots, if you like, who's able to actually bring some of the stakeholders together. And that's what I've had been doing for most of my career, is really working with all sorts of different stakeholders and finding common ground in order to jointly move forward. And that's effectively what I've used over the last, 8 years that I've been on this infinity journey.
Yeah, I mean, very interesting. So you mentioned, no track record, as a fund manager, but obviously you had plenty of experiences, bits and pieces here and there, which you aggregated, obviously. But then when you sit down and say, okay, I take the decision, I do this company, this fund, how do you decide, we'll come back to the name, why Infinity Recycling, but also how do you decide the size of the fund? Is it just what you get, or is it like, okay, I want it to be a growth fund, you mentioned, because this is where you see the biggest opportunity, because you need to find out what is a challenge in the market, obviously. It's all entrepreneurs. And then how can I basically contribute to be part of the solution? So basically, what is the size of the fund? Why did you decide this fund? And what about the name also?
No, good questions. And it's like everything, and being an entrepreneur is like that. It's not written in stone, right? And I think that's quite important. So you do need to have the mental agility, if you like, to change maybe course and also adapt to the situation, listen to people around you. I think fundamentally a lot of what I've done, I'm not necessarily an expert in anything, right? But I am somebody who can kind of absorb different ideas, leverage experience and knowledge that is out there. So coming back to your question, so when we started, and you're probably going to laugh about this, the target we set ourselves was a fund of 25 million. Because we thought, well, we're Dutch, mother's Dutch, this is never going to fly, we need to kind of keep modest. And in discussions with people in the market, coming back to my point about you need to really make sure that you leverage the expertise around you, it became quite clear that for 2 reasons that wasn't realistic. One is, in order to make a real impact, you need to have a large fund, because in a lot of those companies, you want to make sure you can keep investing. Also, you want to make sure you don't dilute in order to get the returns that you promise to your LPs. And secondly, as a first-time fund, first-time manager, you're actually going to be less credible if you raise 25 as opposed to raising 150. so also there you need to kind of have the right story, and that's where our target eventually was 150 million. We actually were able to bring it to 175 million because we actually had much more interest than what we anticipated. And that shows, going back to where I started, that the narrative was good, and that the approach that we have taken, the approach that we pitched at the time, was also something that people recognized as being the right approach, which was all about indeed that collaboration. So coming back to what I said before, what we've done very well is 4 aspects. One is get an LP base, an investor base that is broadly representative of the different value chains. So you have the expertise in your LP base of all these different markets that play a role in this transition, in addition to the financial investors who obviously have the deeper pockets. That you have a team that has investment experience, but also portfolio experience and operational experience. So you can do more than just, transferring some money, which is quite essential. And also, and that's really what we've evolved over the last year, now that we really focus on portfolio management, that you bring experts from the market in what I describe as a bench. So this is effectively a group of, independent people with significant expertise in certain areas that you can bring in for market research, that you can bring in for due diligence on investments that you consider, but also, most importantly, that you can bring in for portfolio management to really support those typically small teams in the companies that you invest in. And I think those are fundamentally important things in order to succeed with what we set out to do as a fund, be a catalyst for that transition, and generally also succeed towards meeting your LP's expectations. And it's something that we've said at the start, it's something that we've executed, and it's something that we deliver on. And I think that's coming back to where we started, that consistency is also critically important. You want to make sure that you kind of stay true to what you know well, what you can do well, and that you deliver, and that you obviously communicate what you've delivered, so that you keep everybody on board and everybody understands, okay, this is what we're actually going to do.
Yeah, you mentioned consistency, and being slightly biased toward composites and high performance. I think high performance, the base of high performance is consistency.
Yep.
It's passion, great ideas, but then obviously just doing and being consistent. But let's come back. You mentioned big numbers, 25 million, big number for most of the people. And you say, oh, not big enough to be credible. Then it's like you go up to 175. First time you do a fund, because it's easy as a 25. So, and then you mentioned the word LP, limited partners.
Yep.
So who are these LPs? They are very different ones, you might explain. And why would they put basically this trust and this money into a fund, with you basically, and your partner, starting it for the first ever time?
Yeah. So it comes back to, as I said at the start, so in order to be successful in raising a fund, you either need to have a track record or you need to have a narrative. Mm-hmm. We didn't have a track record, so then it's about the narrative. The narrative is something that we, I guess, worked on for quite a few years before we actually went out to market. So in 2020, we started fundraising. I was together with my co-founder, different roles, we didn't know each other at the time, already active since, 2017 in the same market. And that obviously gives you a lot of knowledge, also a lot of network, a lot of expertise to your availability, and therewith gives you quite a lot of credibility. In particular because the time we started raising money, it was clear that this was only really going to succeed given the disruptive nature. You're going from kind of a centralized fossil-driven materials economy to a more distributed model involving different players, also with a different balance of power. So where petrochemical companies and maybe brand owners used to be quite strong, you now actually have a waste industry that comes in. You have new technologies that actually will play a role. So that balance of power is changing. And therefore, when we went out, that was exactly the vision that we were able to kind of share with investors and other stakeholders to say, hey, we've been at this for a while. There's actually technologies out there that we know will do the job. They do need to be scaled up, and we need to make sure, and us as a fund manager being a catalyst, that we work with all these different stakeholders and we actually find a kind of, a sustainable process going forward, a sustainable kind of, collaboration model going forward. And I think it's that credibility of being able to kind of verbally explain what is actually really at stake here and how can we actually make this work. That has really helped us a great deal. And as I mentioned, I obviously had the benefit of being part of that energy transition, investing in that energy transition, which was quite similar. So if you look at energy, in particular renewable energy, 85% of renewable energy assets in Europe are owned by financial investors. They're no longer owned by the energy suppliers of the past. They might still, in some cases, be distributors, but they've lost completely. They're not participating. And that's something called the S-curve, which was developed last century by an Irish economist. And it effectively means that, whereas as an industry, as a company, you define yourself effectively by the product that you make or you sell, ultimately you satisfy a need. And what you quite often see is that in those transitions, companies they find it difficult to kind of transfer, to kind of join in a disruptive transition. And the example that is always given is on the ice industry. So back in the 19th century, you would have people going to Colorado to chop ice, ice harvesters. At some point that became ice factories. None of the ice harvesters actually joined in the ice factories. And at some point, you then started having companies like GE, my former company, making refrigerators. Yeah. And all of a sudden, they satisfied the same needs of people being able to cool their food, but there were completely different suppliers, completely different partners. And none of these parties in these two transitions actually joined in the next phase. And this is something quite similar, where the industry that will actually produce the feedstock for new materials will not necessarily be the industry that provided the feedstock in the past. That was predominantly a petrochemical industry who actually drilled for oil and then used the oil to make, chemicals, etc. So I think that's kind of the ability to explain this, the ability to explain, okay, this is what needs to happen, and this is how we successfully, step by step, are going to do this. I think that's quite critical. And your ability to also, if you talk about limited partners, so those are effectively investors that commit capital to you as a fund manager that you can then deploy for investments in a agreed space. So you have an agreed strike zone, and they effectively say, well, we've got this capital that we allocate, and we want you to invest this and manage those investments until exit on our behalf, and we expect in return a financial return, and in our case we expect an impact. So we're an impact-driven fund, we're an Article 9 fund, which means that in addition to a financial return, we are helping to address the waste problem, we're helping to reduce CO2 emissions of the kind of total industry, and we're helping to reduce the dependency on fossil fuels. And again, that is what you set out, and in my opinion, what is quite critical is that you're then also transparent on how you perform against this and measure this and report the performance so that people understand, okay, this is where you're at, this is why it might take a little bit longer sometimes, why you need some additional support. But that transparency, I think, is fundamentally important, and that goes for us as a fund manager, but it also goes for the industry in which we invest. Because I think transitions are great, ideas are great, but ideas without money or execution are simply hallucinations. They don't lead to anything. And I think that's, again, fundamentally important, is that with everything that we look at, we need to make sure we can execute on it. We need to make sure it's something that we can fund, for which we can raise capital, because without that, as I said, they're just ideas and nothing will actually happen from those ideas.
No, I mean, very interesting. You raise very interesting points here. Before going back to macroeconomics and timing, going back to the LPs, so they can be individuals, they can be institutionals. Are there some categories you could share?
Yeah, no, so when we raised money, so we have 20 limited partners. Okay. Initially, in our first close, we had 5 limited partners, and that was a quite broad representation, mostly of the industry, so kind of strategic investors. So these would be big corporates, in the petrochemical industry, in the brand owners, etc. But also some more kind of regionally driven funds that say, hey, we actually want to make sure in this part of the country there's actually a reindustrialization happening. So they're all kind of strategically investing, if you like. That effectively has helped us to make those first investments, build a team, and then subsequently we brought on board a number of family offices. So that's kind of private wealth. And also a large number of institutional investors. So think about the European Investment Fund, think about pension funds, insurance companies, reinsurance companies, banks, and they are typically in there, providing the financial capital. And if you now look at our 20 LPs, so probably 7 of them are what I would describe strategic, sometimes for smaller tickets, and then we have about 8 of them that are large ticket institutional investors, so purely financial investors. And then we have a number of kind of more focused family offices that say, hey, we've got patience, we've got time, and we actually want to help this transition. So that's kind of, I guess, the makeup of our LP base, which allows us 2 things. One, we've got access to a broad representation of the value chains that are going to be disrupted as a result of this transition. And I think that's great input. It also provides for a great network. It provides for a great number of partners that can test samples from our portfolio companies. And you can think about all those synergies. And then 75% of the capital is from institutional investors, which is great because they can sometimes co-invest. They're also typically, if you do a good enough job, they would typically join you also in the next fund, even if the next fund is strategically slightly different from the first fund. So that's kind of the makeup, and that was also a very deliberate choice because we needed those 2 different synergies, if you like. So the strategic representation and indeed the deeper pockets.
Yeah, interesting. So you have these different classes of investors, and obviously they all have eventually different expectations. So you have to manage expectations, be transparent. As you said, I think it's a lot of dialogue and sharing. Obviously, said about patient capital, because we know in these fields where it's about industrial, it's real factories, it's tangible, it takes time. Things often we are a bit impatient, but those things take time. And you mentioned the ice business, and where even though one business would be in this ice ecosystem, they would not be part of the same ecosystem a few years later because they missed it. Some of them might actually have seen it, but they didn't transition.
Exactly.
So it's a matter of timing, but then when you invest, it's also a matter of timing because you will tell us you are also limited in time to give the returns to your LPs in a certain way. So how do you manage time? That's probably difficult. But how do you get this feeling over a portfolio that based on macroeconomics, which you might see what comes, but then you have also crisis. Geopolitics, we have enough events in the last few years. You have to manage with this dynamic environment. So how, as a fund manager, you stay calm somehow and you feel confident that within the time frame you get to the returns what the LPs expect?
No, good question. It's something that keeps me busy day and night. What is important is, so I think there's two things. So one is, as I said from the start, you want to, in my opinion, and that's also part, the explanation of our success, you want to have a certain expertise, right? So you want to be specialized, you want to be focused on a specific segment, and that's also for LPs important. They don't want you to kind of invest in whatever, because that's never an ingredient for success. But at the same time, when you talk about a portfolio, and that's kind of basic mathematics, if you like, you want to make sure you diversify the risk. So you don't want to invest in 10 exactly the same companies that are all subject to the same macroeconomic risk or even microeconomic risk. And therefore, for us, what is quite important is to really build a diversified portfolio that all, I guess, make use of our expertise, make use of the network that we have, contribute to the transition that we're trying to help, accelerate, help catalyze, but that have different kind of risk profiles. And you also want to make sure that if in some cases, and that's the reality, it takes a little bit longer to get to an exit, you probably want to then set that off with some investments where you can get an exit earlier, because it's also about expectation management. And if you can distribute money to some investors earlier, they'll be happier. So in other words, you need to kind of find a balance. If I then talk about at a kind of holistic level, what does that mean? It means that if you look at our current portfolio, we have a number of what I would describe large loops. So those are base technologies that ultimately, when scaled up, will be important for the majority of our residual plastic waste streams. Think about pyrolysis, think about depolymerization. Those technologies take a while to scale up. The markets in which they operate, the longer term markets in which they operate are typically commodity markets. So for those investments, it's quite critical that you get them to scale and that you optimize them so they can actually compete in price. And what you then want to do, and that's what we've successfully done, is have a few kind of closer loop investments where you might not necessarily have to go all the way down to the monomers, where you can actually work directly with the feedstock provider and the off-taker, where in some cases you can actually tap into, I guess, the benefits of a niche market, of a specific segment where there's a higher willingness to pay, where maybe even you can actually deliver a product, sustainable product that's cheaper than the more expensive alternative. So you want to kind of offset what are quite difficult macro-driven kind of transitions, if you like, offset it with more closed loop that are less regulatory dependent, where you can actually compete on price easier for different reasons, and where you tap into a market where there's more willingness to pay and arguably more willingness to go further even before the regulation comes into play. And then in addition, you want to make a few investments, and we have one in AI-driven sorting technologies that actually can be applied in a broader sense. That's not necessarily dependent on one specific market, but has relevance across a number of different kind of subsegments. And again, that are also, later stage. So typically, revenue, post-revenue. So it's also, it's more a question of developing the market rather than scaling up the technology. And I think that's maybe the last point to add. We have a few more capital intensive technologies where we obviously invest and we also bring in other investors, but we also want to have a few investments in less capital intensive technologies where if there's a macroeconomic headwind and the funding market is difficult, where you can still make progress and help the company move forward. So that's kind of how we continuously look at it. So it's really a question of risk return profile. You want to have a balance. You don't want to have concentration risks. And also you want to make sure you have a timeline of exit so that you can actually already distribute capital at an early stage, and then maybe some investments at a later stage, which will also probably be the highest multiples, but they will take a few more years to come to fruition.
Yeah. I mean, this portfolio diversity obviously requires quite some skills. I mean, obviously, economic, financial skills, technical skills, obviously. And we come back to building up a company.
Yeah.
So at the beginning, you are the founders.
Yeah.
And then you said you grow a team. I mean, you need to have these skills within your team. So how do you grow such a team with all the skills?
And also that is it's kind of building, right? So there's a portfolio build, there's a team build. Also there, it's really around being aware. Well, I think it starts with self-awareness, right? So I'm an economist. What do I know? I know how to bring things together. I understand the kind of big picture, but my technical abilities are obviously limited. I did see the opportunity early in that transition together with my co-founder. But what was quite clear for the two of us is that we need to supplement our skills with other team members. And there were kind of three things that really stood out in terms of building a team. One, you want to have people from the industry that have done specifically the investment before, so experienced VC growth capital investors, and that's what we've done. Because it's all about execution, and also your LPs, in particular the financial LPs that make more fund investments, they expect you to be, and rightly, as institutional as possible. So you need to feel, look, operate like any other fund. So that's quite critical for your credibility. Then secondly, you need technical expertise. So we're not a plain vanilla financial investor. It's not, hey, we transfer some money, we cross our fingers and hope for the best. This is all about how do we actually support those companies? How do we identify companies? And that's complex because this is not about an existing business, right? So you're investing in a company and you're having to build the market. So it requires a lot of understanding of the technology and understanding of the market. So we have, in addition to the investment team, build up in our team technical and market capabilities. And we have kind of, effectively complemented this with, as I mentioned before, this kind of external bench of experts, if you like. So those are people that have, deep expertise in particular markets and or areas. Think about indeed the composite market, think about IP management, think about licensing management, all these things that our companies are faced with. We actually have people that can support those companies. And the interest of getting these people in is not about, hey, we want to make more money, but more we want to reduce the risk of these companies not making it. We want to support those companies in a moment where, in all fairness, their capital is limited, their runway is limited. So what you want to avoid is them having to hire a lot of really experienced, expensive people from the market. So that's kind of the role that we play with this external bench. And that's kind of how, from a team build, we're building a team. The third element, maybe just to mention, which I think is quite fundamental, at least it is for me and increasingly also for the rest of the team, is diversity of thought. So yes, you need people with investment experience, you need technical people, you have an external bench, but you also want to have a diverse team of people. So we now have a team of male, female, Dutch, non-Dutch, European, non-European, young, old, and that's really powerful because this is not about me and my co-founder Jan Willem saying to the team, this is what you all have to do. This is about working together. And I learn as much from my younger colleagues as I learn maybe from older experts in the market. And I think that, again, is quite important, that you have this continuous kind of tension, for lack of a better word, in a team where people challenge each other and say, well, I don't understand this. Why are we doing it this way? Why shouldn't we do this that way? And how do you actually get the younger audience on board doing it this way? And I think that's a wonderful opportunity. So that's, I think, an important third angle of our team build, is to make sure we have that diversity of thought. And I've seen in my career too many fund managers that hired the same people. And the last thing I wanted, not having lived in the Netherlands for most of my life, is to be surrounded by middle-aged Dutch men. That didn't really excite me very much, and also doesn't really bring the best out of, the kind of talents that we have.
Yeah, no, very interesting. Yeah, so that's how I got in touch with Infinity Recycling end of 2024. I think Olaf reached out after I was writing some piece about composites and recycling, obviously. And then, now the question on composites. Let's dig deeper into composites. So why is this composites market so interesting, or one of the interesting markets within your portfolio?
Yeah. No, good question. And I think it comes back to your earlier question on, for us, this was a really, and it's something we realized. And I think, thanks to, people like yourself who are part of the ecosystem, I think we've learned that there's kind of adjacent markets from, I guess, some of the core technologies in which we're invested that have different risk profiles, that operate at different speeds, that operate in a different kind of pricing mechanism, if you like. And I think the composite market is a very good example where, and it's fascinating if you think about the kind of disconnect where you have, an increased consumption of carbon fiber. And we see this everywhere. It's the airline industry, it's the car industry, it's the leisure industry, it's the energy industry. And that's, for good reasons, because it has characteristics that are important. It's lightweight, it's extremely durable, it's strong. But there's also quite a lot of scrap from the production process. And there's obviously quite a lot of material that comes back at the end of the useful life. And if you think about the energy and the offshore wind energy market, there's a lot of that carbon fiber and glass fiber that at some point will come back. So, the market itself grows. There's a lot of scrap. I think in the airline industry, I've been told that in China, probably more than 50% comes out as scrap for different reasons. So it's difficult for that industry to actually do something with that scrap. And that's obviously high-spec scrap. It hasn't really been used. It was just supposed to be used in building the actual plane. And at the moment, until recently, there wasn't really an outlet for this. And if there was an outlet, it was expensive and arguably it wasn't that sustainable. And then similarly, at the end of life, it's not very credible if we invest in offshore wind, we say energy transitional grade, and we end up with a lot of carbon fiber and we have to kind of put it in landfill or whatever, or burn it, even worse. So in other words, there's kind of two key drivers of this market becoming more relevant, but at the same time, this market not really having an end-of-life solution. And that's really where our interest has come in, to see, if you connect effectively different industries, then you can actually quite quickly reuse a lot of the, and the rejects, the scrap from the industry, but also the end-of-life material. And I think that's really the exciting element. And in addition, because it's a relatively, depending, you have obviously different applications. You can mechanically recycle it, you can also chemically recycle this. But if you look at mechanical recycling, where we spent quite a bit of time, you actually have a relatively easy process to reuse materials. And to actually reuse materials in, I guess, relatively, it's not as high spec as an airplane, but relatively high spec applications where there's a willingness to pay. You can actually, because it's quite an easy process, you can arguably offer it at a cheaper price than the alternative. And then sustainability pays for itself. So you have a problem, you solve a problem for one industry, you have an easy, efficient process to make product for another industry. You can do this at a cheaper price than the fossil alternative. And you actually solve a problem for another industry who wants to be more sustainable, who wants to probably pay less. And importantly, and this sounds a little bit trivial, but it's quite exciting. So in one of our investments, there's a kind of paddle rackets, tennis rackets, and skis made out of carbon fiber from, the airline industry. So if you're a tennis player, it's quite exciting that you actually play with a tennis racket that's made from, airline carbon fiber. So that's another kind of marketing tool, if you like. So that's really what excited us about this market, is that, yes, there's some challenges around. There's a lot of different specifications. The logistics is a nightmare because it's everywhere. But if you focus on kind of initially some relatively closed loop applications where you put, for example, your factory close to, whether it's an airline industry or whether it's an industry making wind turbines, but where there's indeed scrap, and you convert that into specific products, and you work with those brand owners, you can actually build traction quite quickly. And it's a model that can be easily scaled up because it's not a process that is very difficult, very energy intensive, or requires a lot of capital investment. And that, coming back to what I said at the start, is a nice supplement to some of the base technologies we have in our portfolio. This has a completely different risk profile. It also has a different market that it targets, that has in itself also a different appetite in terms of what they're willing to pay, how fast do they want to move when it comes to the application of sustainable materials. So that's kind of, for us, coming back to your question, why composite, that really attracted us to the composite market. And the moment you're in it, you realize there's a lot of those, because it's quite a complex market and it's not a very centralized market, if you see what I mean.
Yes.
You realize there's different pockets where you can actually make an impact. And that requires knowledge, it requires skill. But I think now that we're in there, that's exactly for us the next step. Is, okay, where are the other pockets where we can apply some of the skills that we've learned over the last, I would say, year and a half. Also, with the support of our bench members. And kind of replicate, because the problem statement is quite often the same, but I'm party A, I'm left with stuff that I can't get rid of and I have to pay a lot, and there's a party B somewhere that actually is eager to get my materials, and how can we actually bring these two together? So it's an exciting market, and it's a market, again, I think, where it's about expertise, it's about having that experience, having that pedigree, and having the network to actually find all these different connections. And that's where we believe we're actually increasingly well positioned to really play a role there, whether that's from this fund or indeed the subsequent fund that we're expected to launch later this year.
Very interesting, if I might put a name. So, I mean, we speak about Fairmat here in the composites field, which is in your portfolio. You already mentioned quite some criteria why it fits well into your portfolio.
Yep.
But in general, eventually on this specific deal, what makes you take the decision, let's invest in this company beyond the criteria you named? So there's probably, you're looking at the team, you're looking obviously at the market itself, the positioning in your portfolio. So what were the key criteria where you say, we check the boxes and we go for it?
If I really simplify it, there's 5 elements to this. 1 is the market. 2 is the proposition of Fairmat in the market. 3 is team, an extremely talented team that really understands how to find an opportunity, identify an opportunity, and to pursue it. 4 is, I think, the fact that it's in France. It's our first investment in France, and I think the French ecosystem is an ecosystem that, because it's all part of an industrial vision, there's actually typically more momentum when it comes to transitions. There's more momentum for companies supporting that transition. And we had the privilege of investing alongside the likes of BPI. And it's been a very positive experience that you see, well, there's actually a real kind of joint focus on making this ecosystem work, developing this ecosystem. Why? Because it supports an existing ecosystem of the airline industry. That's all kind of, in this particular case, based in Brittany. And I think that's really what we need to see. Ecosystems are extremely important also in this transition. So we shouldn't really develop something and build it in a periphery. There needs to be a relevance for the existing industry. It needs to leverage the existing industry because it will help with ultimately the acceleration, and it will also, significantly reduce the payback period, because this is still expensive, and obviously the sooner you get your payback, the better it is. And then fifthly, what we liked about this particular investment is, and that comes back a little bit to my fourth point, is the investors with whom we're investing. BPI I mentioned, there's Slate, there's Singular, so a lot of investors, there's Temasek, a lot of investors that we like working with, that are very aligned in terms of what we want to achieve, and therefore really give us a lot of confidence in actually bringing this company to the next level and ultimately bringing this company to an exit.
So it means also, the ability for such a company to bring together this group of investors who enjoy investing with each other. So that's a key topic. But slowly moving to Fund 2 and market dynamics. So 2 points here which might be in favor for Fund 2 on the dynamics of fundraising.
Yeah.
The one is obviously we speak a lot about material supply chain resilience, sovereignty, especially those days.
Yeah.
We know that, for example, carbon fiber is related to oil. We know the oil dynamics on the market currently and regularly. And on the other side, you also mentioned, you invest in recycling, infinity recycling. When you say okay, scope or thesis of investment, pretty straightforward. We understand the recycling topic, but it's about anchoring recycling in value chains, and you see all these opportunities around that. So, will you basically go beyond the recycling name? So I don't know. Maybe there will be a new scope of the new fund because of course market dynamics and you seeing opportunities around your core on Fund 1.
So maybe to start with, I wouldn't say it's the elephant in the room, but we will probably, I guess, amend our name or simplify our name. So Infinity Recycling will probably become IRC, just to make sure that we don't get, I guess, confused with a company that only invests in recycling. There's obviously other investments that we make. So I think that's quite important to make sure that's also properly reflected in our name as a manager. Where we see the opportunity, and I think that's a very good point. So we started off with investing in some what we describe as base technologies in circular plastics that convert plastic waste back into commodities, into feedstock to make new materials. We've kind of expanded into technologies that are not necessarily active in plastics per se, but other waste streams, if you like. And for our second fund, we'll probably take this still a little bit wider. And the reason why is that the problem statement of doing something with waste streams, doing something useful and preferably reusing them for new materials, really getting to that renewable materials market. The problem statement is quite similar. So in other words, if you have successfully supported a number of companies scaling up, embedding in a broader infrastructure, you can apply those learnings to companies in adjacent markets that deal maybe with other waste streams. And that's really where we see the role of our second fund, which will be a pre-infrastructure fund. And it will effectively bring those technologies, those companies that have successfully scaled to commercial level and help them expand. And help them expand means really help them integrate in the value chain. And there you think about, waste hubs, resource hubs, where you bring different things together and you really drive the synergies between all these different process steps. And what we should try to avoid, as distributed as this model can be, is that you do too many things in different places. And the reason is, and we've seen this now also with the crisis in the Middle East, ultimately this is only going to succeed if we can compete with whatever is the cheap fossil alternative. Whether we like it or not, as a society, we're probably not going to pay much more longer term. And that means that what you really want to make sure is that, and you scale your solution as much as possible within the context of this still being distributed. So it's hub and spoke, some smaller units, some larger units. But you want to optimize this as much as possible. And you can only do this by embedding it into an infrastructure, by really aligning it with different parts of that value chain, so that now you have the waste sourced close by. With the waste, you then have a few different steps that you can take, because there might be different elements in there, different waste streams, and they all have different applications. And then you have effectively, a kind of waste hierarchy where you have different outputs that you can then sell to different downstream players to make new products, make new materials, whatever it might be. So that's really the aim of our second fund. And the reason there's a need for that second fund is that there's still too much uncertainty for the large infrastructure investors in, I guess, buying what are single assets, consolidating them, really driving those synergies, driving down that cost level, so that longer term you get to something that has very predictable revenues, that is very consistent revenues, and therefore becomes attractive to financial investors. Yes. As I said at the start, the renewable energy transition, that's exactly what happened. 85% of renewable energy assets are financially owned. This will be something similar, because the technology is not too difficult, but you do need to make sure you actually scale it up and you actually get predictable revenue streams, so that you can actually get the large longer term investors on board.
Interesting concepts, because you kind of need to manage agility and resiliency, so which is sometimes counterintuitive, but that's basically what you're explaining. It's still not at the level where big infrastructure player will just implement a very resilient system.
Yeah.
So we need a certain agility in this dynamic environment, and that's where you contribute with the other players in the ecosystem.
Yes, exactly. Now that's and that's, I think, a good point. This is, again, and we'll probably have quite a few financial investors coming in, but that's indeed the idea, is that this still builds on this idea of collaboration, of making sure that you get all these different industry players to work together. If you kind of take a step back, this transition, there's a number of key drivers here, and I always make the analogy of a train. So what is important at the start is that there is I guess, predictable regulatory certainty. So everybody understands this is the regulation, this is when it comes into place, this is the penalty if I don't really comply with it. That then helps the industry to become more engaged and to become vested. Think about, hey, I want to make an offtake agreement, I want to make a supply agreement, whatever, or an engineering firm, I want to help you develop the technology. You then have maybe a public funding that can provide a backstop where necessary. So should there still be residual risk that industry players are not willing to take, you can cover that off. And then you get the investors in. And that's the sequence this has to work. That's the sequence it also will work. But that's quite important, that you actually start with the regulatory certainty, should that indeed be a case. There's some markets, as I mentioned before, where the regulation plays less an important role. And then you want to make sure you engage the industry, because we can talk about great ideas, but as I said before, great ideas without proper execution, that's hallucination. And I think that's quite fundamental. So it really, again, is around, okay, how do we actually take all these stakeholders, and how do we, and that's really the kind of philosophy of our second fund, how do we help scale innovation to help reindustrialize our economy? Because we've lost the ability to actually do a lot of things locally. So it's not only about a sustainable world, it's also about building a more resilient economy, about having more autonomy when it comes to energy, when it comes to materials. That's quite critical, and it can be done, it should be done, and it will allow us to actually really, keep driving prosperity, both in Europe but also in other parts of the world.
So you really see a unique opportunity for Europe, obviously, to get back to, some of the legacy. And we have been certainly very important point of developing the Industrial Revolution and so on. So getting back to having the production on site because we have these resources.
Exactly.
Basically, it's coming back to mining. We have these mines of waste, so let's use them. And so you see Europe having a unique opportunity, but also responsibility in taking this.
Exactly. No, exactly. It's indeed the opportunity. It's a responsibility, and it's really it's not rocket science, in my opinion. I think we see the signs on the wall with the industry, the base industry in Europe, not being able to compete because of high energy prices. Now, in certain countries, that problem is worse than in other countries, but generally it's difficult, and we see already industries closing down, moving to cheaper locations. If we're not careful, then we lose that autonomy when it comes to materials, and we will become dependent on the import of materials from other countries. And we've seen what happened when we, I guess, closed our eyes for about 2 decades and realized, shit, we're now dependent on Russia for our energy import. You don't want that in a world kind of, I guess, characterized by geopolitical uncertainty. You want to have some autonomy when it comes to materials, because materials, and I think this is quite important when it comes to plastics, when it comes to polymers, when it comes to other materials, they're the building block of our society. And people, there's a lot of plastic bashing happening, but if you take out plastic or polymers, everything falls apart. And if you talk about composites, composite has brought us a lot of things, and it's because of composites that we've actually been able to, reduce significantly our energy consumption. So it actually net has already delivered significantly on our transition to a sustainable world, and it will do so even further. The cars that we drive now are probably 1/10 of the weight of the cars we drove 10, 20 years ago. So think about the fuel consumption that is being reduced. So in other words, there's a lot of these good things that are happening, and we need to recognize, and we need to kind of support that. And that's sometimes where, obviously, ultimately, a lot of what we do, a lot of policy is decided by politicians. They obviously look for being re-elected in the next elections. We need to sometimes take a longer term view. That's the advantage, the privilege I have. We have a 10-year fund. But I think that's also where we, as a society, we need to look long term and think, okay, how can we actually retain long-term prosperity? How can we make our world more sustainable, more equal? There's a lot of challenges that we need to face, but I think it requires a bit of courage and a bit of longer-term thinking, and the dialogue that we need to keep having.
Thank you so much, Jeroen, for all these insights, bring us into building up a fund, running a fund, and having an impact, because at the end it's about having an impact when you start a journey like an entrepreneur. So thank you again.
You're welcome.
And see you soon here in Rotterdam or somewhere else.
Thank you very much, Yannick. It was an absolute pleasure to be here today. Thank you.
Thank you.